Your credit card payments just got worse, and that's not because you suddenly started spending more or making bad choices, but because a quiet force in the background has shifted against you, rewriting the rules of money while most people weren't looking. Rising interest rates are often described as a tool to cool the economy, but the shocking truth is that for everyday people, they work more like a slow leak in your wallet, draining cash month after month in ways that feel invisible until the damage is already done. Welcome to Meta Economy Lab, where you can learn and understand more about the economy and related topics, so you can subscribe to the channel for continuous learning. Most people think interest rates only matter to investors, bankers, or people buying expensive homes. But that belief hides a contradiction that sits at the heart of the modern economy. Interest rates touch almost every dollar you earn, save, borrow, or hope to grow. When rates rise, they don't just adjust numbers on a screen, they change behavior, shift power, and quietly move money from millions of households into the financial system with incredible efficiency. To understand how we got here, we need to go back to a time when borrowing money was cheap, almost encouraged. After major financial crises and economic slowdowns, central banks around the world slashed interest rates to near zero. This was meant to jumpstart spending, push businesses to invest, and help people recover. For years, cheap money became normal, and an entire generation built their financial lives around it. Credit cards, car loans, student loans, and mortgages all expanded during this era of low rates. Banks promoted easy approvals, monthly payments looked manageable, and saving felt pointless because returns were so small. The system rewarded borrowing and punished patience. Slowly, households adjusted, taking on more debt, not because they were reckless, but because the system nudged them in that direction. Then inflation arrived, and it didn't come quietly. Prices began rising faster than wages. Groceries cost more each month. Rent climbed, and energy bills spiked. Central banks faced a difficult choice: do nothing and risk runaway inflation, or raise interest rates and risk hurting borrowers. They chose to raise rates, framing it as a necessary cure, even though the side effects were well known. Interest rate hikes are often explained as technical adjustments, but their impact is deeply personal. When rates rise, banks immediately raise the interest they charge on variable loans and credit cards. Your balance stays the same, but the cost of carrying that balance grows. It's like walking uphill with the same backpack, only now the ground is steeper and every step takes more effort. Credit cards are one of the fastest channels through which rate hikes hit consumers. Most cards have variable interest rates tied to benchmarks set by central banks. When those benchmarks rise, your credit card rate follows almost instantly. A balance that once grew slowly can suddenly snowball, with interest charges eating into payments that used to make progress. Imagine someone carrying a few $1,000s in credit card debt, making minimum payments each month. When rates rise, more of that payment goes to interest instead of reducing the balance. The borrower feels stuck, paying faithfully, but going nowhere. This isn't an accident. It's how the math is designed, and rising rates make that trap tighter. Mortgages tell a similar story, especially adjustable-rate loans. Homeowners who once enjoyed low payments find themselves facing sudden increases they didn't fully expect. For many families, housing is their biggest expense, so even small changes can throw budgets into chaos. What was once affordable becomes stressful, and stress spreads quickly through the household. Car loans, personal loans, and even buy no pay later plans are also affected. Each rate hike ripples outward, touching every corner of consumer finance. The system doesn't announce these changes loudly. There's no alarm, just quiet updates to statements and subtle increases that add up over time, often unnoticed until money feels tighter everywhere. What makes this situation more uncomfortable is that banks often benefit when rates rise. They charge more on loans faster than they increase what they pay on savings. That gap, known as the spread, widens during rate hikes. While consumers struggle with higher payments, financial institutions quietly collect more interest income, protected by complexity and distance. Historically, this pattern has repeated many times. In past decades, rate hikes meant to fight inflation often triggered recessions or financial stress. The same institutions that helped fuel credit booms later tightened conditions, shifting the burden onto borrowers. The cycle rewards those with assets and punishes those relying on debt, reinforcing inequality in subtle but powerful ways. Savings accounts are often presented as the bright side of higher rates. But even here, the truth is complicated. While rates on savings do rise, they often lag behind inflation. This means your money might earn more interest, but still lose purchasing power. The promise of higher returns hides the reality that many savers are still falling behind. Meanwhile, wages tend to adjust slowly. Employers don't raise paychecks as quickly as banks raise interest rates. This creates a squeeze where expenses rise faster than income, and debt becomes heavier at the worst possible moment. Households respond by cutting spending, delaying plans, or taking on more credit just to stay afloat. Small businesses feel this pressure too. Loans become more expensive, expansion plans stall, and hiring slows. This feeds back into the economy, reducing job growth and increasing uncertainty. What started as a tool to fight inflation begins to reshape daily life, often hurting those with the least room to adapt. One overlooked detail is how expectations play a role. When people expect rates to keep rising, they change behavior. Spending drops, fear grows, and confidence weakens. Markets react not just to what rates are today, but to what they might be tomorrow. This psychological layer adds another hidden cost to rising rates. The most unsettling part is how normalized this process has become. News headlines mention rate hikes as routine events, using technical language that distances the impact from real lives. But behind every basis point increase are millions of altered budgets, delayed dreams, and quiet sacrifices that never make the news. Some argue that rate hikes are necessary and unavoidable. And in many ways that's true. Inflation hurts too, especially the poor. But acknowledging necessity doesn't erase consequences. The system chooses which pain to prioritize and who bears it. And, historically, that burden falls disproportionately on borrowers and workers. There is also a timing problem that rarely gets discussed. Rate hikes affect the economy with delays. By the time their full impact is felt, damage may already be spreading. Policymakers adjust slowly, while households feel effects immediately. This mismatch creates a sense of helplessness as decisions made far away shape daily survival. Stories from real people make this clearer. A family juggling childcare and groceries suddenly faces higher card payments. A graduate with student loans watches interest accumulate faster than expected. A retiree living on fixed income sees savings stretched thinner. These are not rare cases. They are becoming common experiences. Banks frame rising interest charges as neutral outcomes of policy, but the structure ensures profitability regardless of direction. When rates fall, they increase lending volume. When rates rise, they earn more per loan. Either way, the system protects itself, while individuals must adapt without similar safeguards. This is why rising interest rates feel so cruel. They don't arrive as a single shock, but as a series of small cuts. Each statement, each bill, each recalculated payment chips away at financial stability. The damage isn't dramatic enough to spark outrage, but steady enough to reshape lives. As rates continue to climb or stay high, the long-term effects become clearer. Less spending slows growth, more defaults strain households, and stress becomes a constant background noise. The policy meant to stabilize the economy begins to feel like it is stabilizing the system at the expense of the people within it. The uncomfortable truth is that understanding interest rates is no longer optional. They influence where money flows, who wins, and who struggles. Ignoring them doesn't protect you. It leaves you vulnerable to forces that operate quietly but relentlessly. There are lessons hidden in this story. First, debt becomes more dangerous when rates rise, even if balances stay the same. Second, savings alone may not protect purchasing power during inflation. Third, systems designed for stability can still produce unfair outcomes if incentives remain misaligned. Looking ahead, the question isn't just whether rates will fall again, but what we've learned from this cycle. Will policies adapt to protect households better, or will the same patterns repeat? Will financial education improve, or will complexity continue to shield uncomfortable truths? If there is a warning here, it's that silence benefits the system. The less people understand interest rates, the easier it is for their effects to pass unnoticed. Awareness doesn't eliminate the problem, but it gives you the power to prepare, question, and make informed choices. As you think about your own wallet, remember that rising interest rates are not just numbers decided in distant meetings. They are forces shaping your daily life, quietly but powerfully. Staying curious is the first step towards staying in control. Meta Economy Lab gives you a new perspective to see and understand more about the economy and related topics, so you can subscribe to the channel for continuous learning.